Some market crashes you can see coming. There are warnings, there's panic in the air, but not this one. February 5th, 2018 started out like any other day. No major news, no big shocks. And yet, by the time the closing bell rang, a financial hurricane had ripped through the market, wiping out billions and coining a new name for fear: Volmageddon.
All right, let's get right into the chaos of that afternoon. Because to really get what happened, you have to understand this wasn't just a few investors having a bad day. Nope. This was a total structural collapse of a really popular and, it turns out, really dangerous corner of the financial world. We're about to solve a multi-billion-dollar mystery.
So, here's our smoking gun. This is the VIX index, what everyone on Wall Street calls the fear gauge. It's supposed to measure how much turbulence the market is expecting. Usually, it moves a little bit here and there. But on February 5th, it didn't just move, it absolutely exploded. Look at that. It went from just over 18 at the open to more than 37 by the close.
That's more than double. 102% spike in a single day. That's one of the biggest jumps the VIX has ever had. All of a sudden, the thing that was supposed to measure fear became the very source of it. And for anyone on the wrong side of that move, the results were just catastrophic.
Just think about that for a second. These products that people had poured billions of dollars into were suddenly worth less than 10 cents on the dollar. Poof! Gone in a matter of hours. So that's the big question, right? How on earth does the market's fear gauge double and vaporize entire funds on a day with no obvious terrible news?
Well, to get to the bottom of it, we have to look at what had become one of the most popular, most crowded trades on the street. For years, it felt like a sure thing, a guaranteed moneymaker. And what was it? It was a simple bet that the markets would just stay calm.
The whole story really kicks off with this new wave of investment products called exchange-traded products, or ETPs. As researchers have pointed out, these things basically open the door for anyone and everyone to make these super complex bets that used to be just for the big hedge funds. And boy, did they get popular fast. The growth was just off the charts.
So, what were these things, really? Let's break it down. Products with tickers like XIV and SVXY were called inverse volatility ETPs. In plain English, that means when market volatility went down, their value went up. It was kind of like selling insurance. As long as the weather was sunny and the seas were calm, you just sat back and collected cash every single day. Easy, right?
And this right here, this gets to the absolute heart of the risk. See, when you buy a stock, you own a tiny piece of a real company. It's a tangible thing. But these ETPs, they were just contracts, pieces of paper whose value was tied to this abstract idea of volatility. As a few analysts cleverly put it, there was no there there. If things went south, there was no one who would step in and buy it just because it was cheap.
So if they were so risky, why did everyone pile in? Well, look at this number. In the super calm years leading up to 2018, the returns were just insane. We're talking over 1,000%. From the outside, it looked like an actual money printing machine. Who wouldn't want a piece of that? But, and there's always a but, there was a fatal flaw. It was hiding in plain sight, right there in the fine print of how these products were built. And this flaw, under just the right amount of pressure, could trigger an unstoppable feedback loop, one that would turn a tiny spark of volatility into a full-blown inferno.
Okay, this is the engine of the entire disaster. The best way to think about it is like that horrible screeching feedback you get from a microphone at a concert. It starts with a small sound and gets amplified into a nightmare. So, step 1, volatility ticks up a bit. That causes these ETPs to lose a little value. Now here's the deadly part. To rebalance their books at the end of the day, they were forced, literally forced, to buy VIX futures, the very thing they were betting against. And all that buying just pushed volatility even higher, which started the whole vicious cycle over again.
Now, the really crucial thing to get here is that this wasn't some small, weird strategy. By 2018, just 2 of these products held a combined $3.5 billion. The trade had become unbelievably crowded. You had all this money packed into this one automated strategy, all heading for the same tiny exit door.
And the result of that? Well, analysts figure that by the end of that day, these ETPs had to buy something like 93,000 VIX futures contracts just to rebalance. That's almost a quarter of the entire average daily volume in that market. It was, no joke, like a blue whale trying to escape through a keyhole. It was never going to work. It just blew the door off the hinges. So that crazy feedback loop, that explains the how. That's the mechanics of the explosion. But later on, some researchers at a firm called Option Metrics were digging through the data and they found something else, a clue that might just answer the why. Why did it all go down with such incredible violence on that specific day?
You see, that mechanical unwinding was always a time bomb, just sitting there waiting to go off. But the data from that morning suggests a tantalizing possibility. Did someone light the fuse? It looks like someone, or maybe some group, placed a monster bet that the VIX was about to go to the moon. Get this. According to the Option Metrics data, on the morning of February 5th, someone bought over 400,000 net VIX call options. Let me put that in perspective for you. That is more volume than you typically see in an entire day of trading.
And here's the kicker. This absolutely massive trade all happened in a tiny 10-minute window, way back in the morning, long before the VIX really started its insane surge in the afternoon. It's like these traders weren't just predicting the fire. It's possible they brought the gasoline.
A trade that big triggers something called the negative gamma effect. Just think about it. The market makers on the other side of that trade, the ones who sold all those options, they're now in a really risky spot. To protect themselves from huge losses, they have to buy VIX futures as the price rises. This created a second, powerful wave of forced buying, just pouring fuel on the fire that the ETP rebalancing had already started. So, okay, we've got all the pieces on the table now. The super crowded trade, the flawed product design, the death spiral feedback loop, and this mysterious, perfectly timed catalyst trade. So what's the big takeaway here? What did we learn from the ashes of Volmageddon?
You know, I think this quote from an analysis by the Certified Futures and Options Analyst organization, the CFOA, just hits the nail on the head. At its core, Volmageddon was a story about complexity running way ahead of understanding. You had billions of dollars chasing a strategy with fatal flaws buried deep inside the product's DNA.
So the lessons here are actually timeless. This wasn't just some random market event. It's a perfect case study. First, it showed us just how dangerous crowded trades can be. When everyone is on the same side of the boat, it's going to tip over. Second, it proved that a product's very structure can hide these ticking time bombs, these feedback loops that only show up under stress. And finally, it's a brutal reminder that in these abstract derivative markets, there might be no one there to catch you when you fall. And that right there is why professional education, the kind of deep dive the CFOA provides, is so critical for anyone playing in this complex space. And that kind of leaves us with one last big question. The exact products that caused Volmageddon are mostly gone now, but our financial system is always creating new, complex ways to trade. The hunt for the next big thing never stops. So the next storm is definitely brewing out there somewhere. The only question is, will we understand how it works before it makes landfall?